So monetary policy, M2 growth, still slowing down. It peaked, I think, in February at 27% and is now down to about 12%. Now that's higher than it was pre-pandemic. Back then it was in the 3 to 6 or 7% range. So still quite a bit higher. Quantitative easing still is in place. The Fed did say this week that it's looking to taper, but we've gotten some signals this week that may have the Fed reassessing how quickly it will taper. Employment today was one of them. Retail sales over the last few weeks, disappointing, and in particular, auto sales. We'll get into that in a minute. On the fiscal policy front, well, the $3.5 trillion package is being debated in the House, and I think we got a signal from Senator Manchin of West Virginia this week that and he has a very important vote in the Senate, he thinks $3.5 trillion is just ridiculous, given that debt to GDP ratio, government debt to GDP ratio in the United States has already passed 100%. Before the pandemic, we were in the 75-80% range. So 100% is quite the marker. And he's also concerned about inflation and that a fiscal package of that magnitude might aggravate some of the inflation indicators that have been flashing red recently. I think that's a very good thing. If he is not for this package, it's not going to pass. I think he's much more for the $500 to $1 trillion pure infrastructure package. We'll see what happens. We do know that this $3.5 trillion is filled with tax increases. Tax increases, I would say, on the biggest job creators out there. That's problematic for those who are worried about the employment situation. It also it includes another tax that I actually thought we'd see much sooner than now, a carbon tax, or a number of different carbon taxes. And we may end up seeing a tax like that. It is a very broad-based tax. It's very regressive, so we'd have to put in place some credits for lower income individuals. But for those who are concerned about the environment, this might be an acceptable tax to pay for perhaps the infrastructure program that hopefully goes through. Okay, so on to the economy. Today, we got an employment report that was very weak relative to expectations. 235,000 increase in non-farm payrolls. The expectation, I think, was around 733,000. And last month, it was revised up to over 1 million. Now, we're trying to figure out, okay, what is happening here? Is it because of the Delta variant of the coronavirus and the pulling back of activity associated with that? Well, I guess this report corroborates that, because leisure and hospitality employment was flat. And those numbers had been coming back very, very strongly until this month. So that's a probable reason. Is it because of supply chain issues? We're hearing about shortages, especially chip-related shortages, chips that go into everything manufacturing. Well, here too, we have some clues. Manufacturing hours worked were down 0.5%, which is a very big drop month to month. That's about 6% when you annualize it. So again, a big drop in a real indicator, not being influenced by inflation. Construction employment was also down. Again, there could be supply chain issues